In this episode, I continue with part 2 of my interview with Brock Waterman, who achieved financial independence at the age of 42. Today, his wife and 3 children travel the world, never having earned a salary of more than $65,000 a year. Today, they are earning over $10,000 a year in dividend income, along with their other investments. Hi, my name is Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. Let's continue with part 2 of my wide-ranging interview with Brock. How do you think about, or do you think about dividends differently when it comes to retiring later when you're 65 or retiring early? Are you looking at dividends differently at all or no?
That's a good question. I don't know that I've thought about that, honestly. I think probably everybody's shaped by their experiences, right? So my experiences in investing were very young, formatively for me. My formative years were the 2001, 2007, 2008. So for me, capital preservation is just one of the most important things. If you lose your investment amounts there, you lose 50, 60, 70%, it's I don't want to say it's not recoverable, but it's a lot of work. I lost 40% when I had $20,000. That was a good time to lose 40%, honestly. So I think when you're looking at dividend stocks for your, I don't think I would have a difference for it. I guess I would think for us the biggest thing is we're looking for the yield that we can live on, and we're looking for companies that aren't going to cut the dividends. Maybe you'd be a little more aggressive if you're younger, looking for things that are more growthy in your dividend. There's some places, there's some that pay like a 2 or 3% dividend, but they're growing it over time. I have a few of those, but I'm probably a little more aggressive in the sense of I'm looking for more. We're trying to have 5-6% is our target, but we're doing it in a way that we feel comfortable with. Obviously, with the due diligence and looking into the earnings statements, and then I also read a lot of analyst reports, and I read things that are put out on Seeking Alpha. It's another good tool that you can sign up for. It's less than a couple $100 a year, and you can read reports that people are putting out. You got to be a little careful about the people putting out there, because I think a lot of times they have positions and like that, so you got to kind of read it for what it is. But a lot of people actually dig in very deep, and there's some really good articles you can read. I read stuff from Motley Fool sometimes, and then I'll look at the reports as well. But I guess I'm not sure the answer to your question. I think that I would go ahead and you could be maybe a little more aggressive if you're not trying to retire right away. Obviously, at the point we're at, we really don't want to lose the capital that we've set up. So that's probably one of our biggest things now.
Mm-hmm. Now, the next question, I already know what the answer is. In my mind, I want to hear it from you. And I think it's great for the audience to hear it from someone else also. And the question is simple. When should somebody start investing?
As soon as you can. I think you want to. Okay, so I think the biggest thing people that I talk to sometimes don't understand is the best return you can make straight up is if you work for a company, is making sure that you're taking whatever match they're going to give you, get that, right? So if let's say they say you're going to put 6% there and they're going to match 3%, well, you put your 6%, right? And just find a way to take all the other cents off, because that's an instant 50% return. And there's no other way to legally do that in a guaranteed manner, right? There's nothing that's close.
It's free money.
It's free money, right? So past that, obviously, if you have really high debt loads, whether it is things like credit cards and other stuff like that, you need to pay those off, because you're probably not going to make the 25% that you're probably paying for your credit card at this point. I don't know what the average rate is. I thought I saw something that was in the 20s, maybe, but it's high, right? So, most investments, you're not going to go ahead and you're not going to make more than that as you're going through. So you got to look at what your debt loads are and get those things paid off. But I think you want to start investing early. And even if you don't have a lot of money with it, I think you almost have to do it. There's, as you know, there's games, there's different things you can go out and you can do and you can simulate it. And I think that's fine. But I think until you actually have the money there for it, I don't think it's the same for most people, because you're not going to feel how you are. And you got to figure out what you're good at. Some people are really good traders. I'm not. I've tried to do it before. I'm not a good person to be in and out and doing all this different stuff. I'm not a day trader. It just doesn't really match who I am as a person.
Plus, it's time consuming.
It is time consuming.
If you were going to do that, yeah, it's very time consuming.
Yeah, well, and that's the other thing people would probably say about looking at the financial statements too. They could say it's time consuming. I mean, like reading earnings reports is time consuming. So maybe some people wouldn't do that. But I think the thing is too is you got to say how many positions are you actually going to have, right? So if you have a portfolio and you're starting out with $5,000, you're probably only going to have a couple positions, right? You don't need to have. There's no reason to have 10 positions because you're going to spend so much time. It's not going to be worth it. And if one doubles, okay, so it goes from $200 to $400, you know what I mean? Like it's not going to really significantly increase it. So you're probably going to have a couple positions. For us with the amount of money we have, I'm looking at around 30 positions, 30 to 40 positions that I'm having and like that. And that's honestly too much too. And I'm kind of, I'm cutting them down as I go because I'm feeling if I find something I like better, I will switch, We have most of it is in dividend. There's some other fixed income. And then I have a portion of it that I'm doing that's growth stocks or value stocks that I'm investing in that don't have a dividend. But I honestly find that part a lot harder to manage and to deal with because I don't have that constant money that I'm getting paid for the dividends, which I just love. So I think people should start as early as they can and then figure out how much time you have for it. And then be careful with it and make sure the money you're putting up is money that you can lose. Don't do the money you'd have for food or for family or for things like that, obviously. But as soon as you can, get some money in there and go for it.
Yeah, absolutely. And what I teach people is this is money that it's for the long term. It's money that if there's any money you need in less than 5 years, whether it's for education, a down payment, vacation, or whatever,
emergency fund,
don't put that in the stock market. Right?
Yep.
Yeah. What we're talking about investing is for the long term, right? Money that you need.
Yep. Absolutely.
And what did you said emergency fund?
Emergency fund. Everybody should have an emergency fund.
Absolutely. Yes. Super important. Now, you talked about the number of positions, right? And you're looking at maybe making it a little bit smaller. How do you diversify we're just talking about the dividend stocks for now. How do you diversify your dividend stock portfolio?
So the way that we have some that's in REITs, which are real estate investment trusts. So that's essentially you're owning property. One of the reasons that we did that is since we sold our house, we don't So let me back up for a second. So you want to diversify as you're an investor. You want to go ahead and you don't want to have everything in one category. So for instance, if you had everything in one category, I always think of technology and I always think of 2001, right? Now, there's stocks that came out of that just fine. Amazon, right? That end up making a lot of money over time. But there's a point where if you have all your eggs in one basket, you can go ahead and you can lose a lot of money. And it can be in anything. It doesn't just have to be stuff that sounds super aggressive. I mean, think of the banks in 2007, 2008, think of Bear Stearns and like that. That went out of business, went to zero, and people are thinking they had their money in their bank. They think they're doing the right thing. I don't know if they paid a dividend at that point, but they think they're doing the right thing. And then all of a sudden it goes down. So we think of it as across assets, how we have it, not necessarily, for me, I was a futures and options broker. I passed my Series 3 at one point. So I help people buy and sell options and futures and commodities and like that for a few months till the company got sold. I didn't work for the new company, so I quit. And in that time, I looked at that, and that's very counter to how stocks move and how bonds move and like that. So you kind of try to understand. So for us, where we sold our house, we don't have any real estate, and real estate's been very good to us over time. We've done a very good job of making a lot of the money we've made has been actually from our own real estate that we've had, that we've bought and sold and like that. So we don't want to not have exposure to real estate prices because it seems like house prices over time do nothing but go up, right? So with the REITs, we're able to have that exposure, and we have things like hospital REITs, and we have things like industrial REITs for like storage for like Amazon and things like that, where they're sending product back and forth. We have commercial like rental leases, have a couple office ones, very selective in that because it's been a pretty hard time for them. So and you can go through it and you can see we even have a couple ones that have for like cannabis, so that those ones have a higher return. There's a lot of research for those because they're the top end of that risk spectrum, right? And then we have the dividend stocks that we have, and there's ways to look at this too with the stocks. There's dividend stocks that are kind of your slow growers over time, that are your consistent ones, and you've mentioned a few of those already. And then there's your ones that are almost that one that they're paying the dividend and they're just going to pay the same dividend all the time, right? And they're paying a high percentage on their yield, but they're just trying to make sure they can keep paying that yield, and they haven't upped that in 2, 3, 4, 10 years, right? So that's an option. And then there's your ones that are actually trying to really grow, and they're trying to very aggressively grow, but they happen to be paying a dividend. So you can see different spots within that. So I kind of break it up within what the type of dividend stock is, or REIT, and then I kind of look at what the sector it is that it's in, and I try not to have anything that's too high of a weighting for us in our portfolio. I have 5 different position sizes that I'll do, so I don't invest the same amount in each position. There's some ones that I consider huge positions, which are 6%. That's the most I'll invest in any one position, right? And there's some that are small that are a percent and a half. And those are ones that I don't want to say taking a flyer on, but there's something that I'm kind of like watching really closely and thinking, is this the right thing? Is it not? Some of those ones I'm thinking maybe they're paying a high dividend yield now, but I'm maybe worried they'll have a dividend cut, so I'm trying to, and then I'm thinking, where do I want to buy these? So I plan out where I'm buying them like well ahead of time. I think, what's the entry price I want in these, and I'll wait for it. And the thing that's been good about the market now is that I've been able to get in a lot of positions because I'm very patient, and I'll wait for the market to kind of come for me. And if it doesn't, I don't buy in. So I'm about 30% invested right now with what I've had, and I've been basically buying positions since last June in the dividend stocks at this point. So in some positions, I'm up to almost 90%, and I've got it filled because I bought a lot of them over like 8, 9, 10 buys. Like, I'm not buying them all at once because then I don't have to get the price right. I know what yield I want, and I'm kind of seeing where things go. Ultimately, I don't know what the market's. You never know what the market's going to do, but I don't think it's going to go down half from here. But could it go down another 25%? Yeah. Who knows what happened? I know with I think we're talking on this Tuesday. Powell just come out and talked about the rates being higher today. So I'm kind of watching those things and seeing what's happening is there as well for buying in. Over the long term, once I get this bought, then there's a lot less work with it. Then I'm probably more looking at the earnings reports. I'm maybe reading a few stories about it, and then I'm just checking on the financials to make sure things are looking good. I think over time, once I get through the buying phase, the dividend stocks will be nice because there'll be a lot less work over the long term, because then I can just sit there and have the positions and take in the dividends as it's going, and that's what we ultimately will be living off of as we're kind of transitioning into this.
Mm-hmm. Yeah. So, question for you: what if, again, with the dividend stock portfolio, let's say you're in a energy sector, you've got a position in an energy sector.
I got a couple of those. Yep.
Let's say in the next year it just goes through the roof, and now you're overweighted in the energy sector. Will you just hang on to those stocks because they are paying dividends, or will you sell a portion of it so that you're no longer overweighted?
That's a good question. I haven't really got to that point yet, so I don't necessarily know what I would do. I know what I've done historically. I've typically sold a portion of it when I've been buying things in different times, but my investment outlook and time frame and goals were different. So now my goals are so much more capital preservation. The thing that's interesting with you use the energy stocks. So the 2 that I have now, they pay variable dividends, right? So which is a whole nother category of thing to look at, because most people, as you know, I think most companies pay a set dividend over time, and they're trying to increase it a little bit as they go. If you look at like a Pioneer, or you look at like a Devon, there's a couple of the ones that I have some positions in, they're paying a percent of what they're making, and that percent's really heavily tied to the price of oil. So, and I just got into them recently because they were too expensive for me, and I waited for the price to come to me, and lately oil has been kind of more in that $70, $80 a barrel range. So I've kind of had to wait for that to come down to get into the position for it, because I wanted the yield that I would expect to be high enough. But they're going to make, if it goes up to 120, that stock could go up a whole bunch, and maybe I would. Where I'd be more likely to sell, and I actually have, is there's a couple of stocks that I bought, and those are both REITs, but and they're paying about 3.5% dividend yield, and they went up 40% in about 2 months, and that's over 10 years of dividend return. And I was just like, well, I got to take some profit on these now, and then I guess I'm going to come back to it because I believe in them, but I don't believe in them that much that I'm not willing to take that kind of instant return. And then I'm buying them back in as the price comes back down, and I've already bought some of those positions back because it was such an increase so quickly. That's where the market's a little bit interesting right now. It's a little bit, I guess maybe manic's the right word. I don't know what's the right word for it. It's up and down a lot right now, right? So January was a pretty crazy month with what was going on, some of the returns of things that have happened. I've had some other positions that I've had that I bought like a month have been up 50%. it's hard not to take profit at that point, So
Yeah. So things have been kind of up and down. Even
yeah.
if you look at last year, you look at the Federal Reserve has increased their interest rates. The same thing in Canada. The Bank of Canada had, I believe, there was 6 or 7 increases in the interest rate.
Hmm.
They also increased it again just at the beginning of this year. And inflation is running at, depending on what you read, 6%, 7%, somewhere around there. And so there's a fear that if inflation stays that high, things are not going to turn out well. So
Hmm.
the federal banks are doing what they can to sort of slow the economy down. Now, the other thing is if you slow it down too much too fast, now you're going to start seeing people losing their jobs and
Yes.
unemployment and all this stuff. And does any of that scare you? And are you changing your approach to the way you've been investing so far?
Uh, excuse me. So I would say everything scares me a little, but I don't lose sleep at night about any of it. So it all kind of goes into the decision making process and then understand it. Honestly, this is kind of what I've been waiting for a little bit to get invested is a pullback and like that. Because I don't, I've seen enough market tops, I've seen several of these now that I kind of feel like long term things will be okay. I think with dividend investing, one of the real beauties of it is that it gives you that chance to think a lot longer term about things because you're really trying to get that yield set up and you're trying to get a very consistent yield. Now, that said, when I'm looking at things like REITs, especially, they have to borrow a lot of money or they have to issue stock to be able to buy the properties that they're buying. So I'm looking at what they have in fixed interest rate lending, and I'm looking at what they have in variable interest rate lending. And I'm obviously looking for ones that have more fixed and hopefully don't have major debt payments that are going to come back out that they're going to have to refinance until 2025, 2026, 2027. So I'm going enough in depth to look at it to see, and that information is pretty easy to find, to see what are they at for the interest rates, because if the interest rates surprise us and end up staying high for the next 2-3 years, then you got to be ready for that. Because if you don't, that's the thing that can go. If you have high interest rates for a company that's already struggling and they have to pay a whole bunch more debt and they have a high debt load, that's something that could put a company out of business or make them have to sell or do something like that. That's where it's nice for the ones I'm looking at. They have this low enough debt loads and they're able to easily enough cover it by the cash flow that they make now that unless we kind of hit depression level things, I would think that, it'll be okay, that most of the things I have will be okay. So I think you really have to understand the environment. Like what you're talking about is spot on, that you have to understand where it's at. But then you have to think, how does this actually apply to positions that I have, right? So I don't just want to be fearful in the sense of being fearful to be fearful. I want to think, how do I take that and think about what that's going to do and think of the long-term impacts and then bring it back to the investing that I'm doing. What do you think? I'm interested to hear what you think kind of all about the environment right now.
Yeah, so a lot of people ask me this all the time. I get emails all the time, and no one can accurately predict where the stock market's going to go. So I don't know what's going to happen next week, next month, or next year. It's either going to go up or down. I have no idea. So nobody can predict that. But having, like I said before, I've been doing this for 25 years now as a dividend investor. I have some confidence that when we look at companies like, well, Coca-Cola was one example, Procter and
Mm-hmm.
Gamble another example. In Canada, we have the 5 big banks. Again, they've been paying dividends since the 1800s. So when I look at those kinds of things, it gives me confidence that, hey, next year they're going to pay me a dividend.
Mm-hmm.
Hopefully increase it, but if things go bad, okay, they'll just pay me a dividend. In 2008, 2009, the financial crisis hit. We saw companies like Washington Mutual go completely bankrupt,
Mm-hmm.
disappear. In Canada, we were a little lucky. The 5 big banks, the national banks in Canada, did not cut their dividend. They kept it the same. Now, they kept it the same for like 5-6 years. However, they didn't cut the dividend. So
Right.
as a dividend investor, that's good because I'm still getting the income. That's good. And then after that, after the 5-6 year break, then you can see even most recently in the last 2 years, the dividends have shot up, have gone up. So
Yeah.
that's been good.
Well, I think the thing that speaks too to knowing your environment and knowing how what's happening applies to what's going on. I'm guessing they had better capital ratios. They're probably better capitalized, the banks were in Canada, than the banks were in the US. They're probably a little bit more conservative in that sense. And that's probably what helped them kind of get through that time. And maybe they weren't participating as many mortgage-backed securities and everything that way. So I think that's where it's kind of interesting, because if you understand the environment, I understand that credit default swaps and mortgage-backed securities and all that stuff most people aren't going to understand. You talked about how hard things would be to understand. I'm a finance guy, and that stuff still is complicated, right? But in general, if you understand the banks you have and how aggressive they are and what they're doing, you can kind of get a feel for the story that's going in and what they're going to do during bad times. So I think that's great.
Yep. And one of the benefits, the other benefit of dividend investing that we haven't touched on yet, is the way the dividends are taxed. Now, in Canada, I'll talk about that because I know it very well. There's a similar situation in the US, but in Canada, for example, outside of, we call it the RRSP or the TFSA, which would be like your 401k or the Roth or the IRA, outside of any of those retirement registered accounts, in Canada, in Ontario, you can earn up to $65,000 a year in Canadian dividends and pay hardly any income tax. I think it's like $700. That's it. Now, if you were making $65,000 in income, you would pay, I think it's like $15,000 in income taxes every year. Yep. So there's a huge benefit to that. And I know in the US, it's something similar, again, outside of the 401k, outside of the Roth and IRA. It's different from state to state. But somebody had shown me a stat a couple of months ago, and I think it was about roughly $110,000 in US eligible US dividends would be relatively tax-free. No federal income tax, at least.
Yeah, I don't know the exact number. I was thinking it was around 80 for somebody if you're married filing jointly. But I don't know. Yeah. It could be higher. I haven't quite got to that point in my how much dividends I have coming in yet. So I know what we're doing is going to be all tax free on the company side. For us, when you do so companies are ordinary. They're considered ordinary dividends in the U.S. So that's the tax free thing that you're talking about. For REITs, I don't remember the exact term for it. It's not complicated, but there's another term that they have for it. And what they do is they take a percentage out of it and they figure out, and a share of it goes to ordinary dividend, so you're not taxed on it, and a share of it does go to that, and you are taxed on it, because I think it's something to do with the gain of the assets on it. So REITs are a little bit different in the dividend sense in the U.S., where you have some tax on it, but it's not a lot. I think it depends on the company. It depends on how they set their distributions and all that stuff. But for companies, yeah, they're straight. You don't have to pay until you hit that limit. And that could be by the state too. Maybe that's why the numbers are different for different people.
Yeah. No, so that's great.
That's great.
So the other question I had was, do you own any mutual funds, index funds, or ETFs? Yes or no?
No mutual funds, because I do not like the payments of. So the thing is, if you look at how much you're going to make, so one of the things that people talk about when you're doing FIRE is if you pay somebody else to manage your money, that eats directly out of the return that you have. So let's say you're paying somebody 1% fee. People think, well, 1% is not that much, right? But if let's say you're trying to pull 4% from your investments, well, now you have to pay 5 to take that 1% fee out for what you're doing. So I don't own any mutual funds. I haven't in a long time. I will do some index funds if they have low expense ratios. I've not done that with the dividend stocks yet or anything that way. I've never done anything with those in that sense yet. I don't exactly know why. I've looked at a few. There's some of the ones I've looked at. But I think I like the idea of being able to be very specific and look into the company and understand that company's story and the financials for it. But yeah, I haven't got much into that. I do have some general indexes that aren't index funds that are not dividend specific.
Okay. Yeah, and you mentioned a good point with the fees, because I'm looking at it right here. So just as an example for our audience, if we were to take a MER, which is a management expense ratio, of 1%, and you had $500,000 invested in a fund that was charging you 1%, after 10 years, you'd lose $95,800 to fees. After 20 years, $395,600 to fees, which is crazy. Like, I would rather you keep that money for yourself. And that's
right?
just 1%.
This is
And
1%. Yeah, and there's some
unbelievable.
and that's the thing is too is there's different. You start getting into different things. There's different percents that are actually charged on that. There's different management fees, and there's different things and how they take the distributions. And sometimes it's not as clear as what the expense ratio says, I feel like, either. So yeah, it's complicated. I mean, the thing is, if you're starting out and you need to have somebody help you along the way, and you have somebody who's very helpful and you're learning from it, it's one thing. But it's ultimately, what are you getting for that 1%? And then when you understand that, you look at most mutual funds, and most of them underperform the benchmark that they're after. I mean, you start really thinking, why am I paying 1% to have underperformance versus the benchmark? Because at that point, then you might as well just buy the index.
Yeah, that leads to my last question. There was, what advice do you have to someone who has been buying nothing but mutual funds for the last 10, 15 years, right? And they're scared to take that money out and put it in individual stocks. What advice would you tell someone?
I think the first thing is you got to understand yourself as an investor. You got to know, what are your goals. You got to sit down and say, if you're somebody and you're at retirement age and you're more traditional retirement age, right now, CDs and bonds. I mean, there's a CD that I was looking at CDs because I'm looking for CDs for my parents, because they have money and they've been getting the 1% in the bank or less for a long time, because there really wasn't a lot of options, and they're very, very, very conservative, right? So I have to find something that they basically can't lose their money on, right? So I was talking to them about bonds, buying treasury bonds and like that, and we did I-bonds last year. I-bonds is another great thing where you can do, but we had to get them comfortable with it. So if you're really conservative and you really can't stomach seeing your accounts go up and down, well, then go find something that works out for you. And right now, there's lots of alternatives. I mean, the rates haven't been this high since, I think, the mid 2000s. So I think that I saw that the interest rates the bond rates went higher. The 10-year, I think, went higher than it's been since 2006, last time it's been this high. So, you got to look at it and say, how does this make sense for you? So they could do that. But I think the thing is, portion it out, right? If you're a person who is a younger person, you can be a lot more aggressive with it. I mean, don't buy, okay, you can buy crypto if you want, but do a very, very small amount of it, right? I talk to these people all the time that want to go buy cryptocurrencies, and a lot of them think that's probably how we got to where we're at, is that we did this one investment that tripled our money or quadrupled our money and did all this stuff. And I'm just not that guy. Maybe that's done that for somebody somewhere, and I'm sure they talk about it on Twitter all the time if it's happened for them. That's cool, but that's mostly not going to work for most people, right? If you're the people I had a friend who was a really in-depth computer guy, engineer, and like that, and he was talking about Bitcoin before anybody else cared about it, right? And he's probably got a bunch of Bitcoin, and he's probably got a bunch of money from it. Okay, great, but he mined it himself with his computer server farm that he had. All right, cool. So, but you can do anything, but if you're going to do something like that that's really aggressive, do it in a very small amount. I think the thing with dividends is great is it's so much less risky than all these other things if you set it up right and do it right. Like if you buy the companies you're talking about, like the Procter & Gamble's and the Coca-Colas and like that, the stock price could go up and down, but the history has shown that they're going to pay the dividends that you have come through. I think the thing is too, you look at property, and I think some of the REITs that I look at like an Alexandria property, and they are an office property, but they're with the biotech companies. So they're building this huge new facility, and Bristol Myers Squibb has already rented the whole thing out. So the people that you're talking about as companies are a lot of times running from these REITs and like that. So they have pretty stable amounts that are coming in, and that dividend's not super high. I think it's in the threes. But I feel like it's growing over time, and I feel like it's going to be very good. So you can find these things that are really conservative, and you don't have to be going for some of the things I have that are 10, 11% dividend yield. But I've done a lot of research, and I'm still kind of back and forth on them a little bit, and I'm watching them. They have a shorter leash than most things, right? They could easily transition into these safer areas, and they could make a lot more money with what they're doing, and they don't have to pay the fees. And then the thing that I think people get really hooked on is having that check come. I mean, there's some things that pay monthly dividends. You look at like your realty incomes, and there's a few that pay monthly. Most pay quarterly. But you start getting that check all the time for it. If you're living off of income, you can really go ahead and you can really make a lot more money and have it come to you and have it be safe. And I think over time, I was looking, I don't know the exact for this, the exact time period, but the dividend stocks over time have outperformed the growth stocks over time. If you look at that consistently, yeah, if you take it down to any 1 year period, there's a chance growth stocks could crush dividend stocks in that sense. But if you're trying to hit that 1 year period, good luck. But if you're looking over time, the dividend stocks have so outperformed because you're typically having a company that's sturdy enough to pay that monthly payment all the time. They can't be taking all kinds of crazy risks or doing things way out of line. They're growing their company as they're going, and they're growing their dividend as they're going. So you just are going to have that payment come through for it. So I mean, and I really like it on the REIT side, and I really like it on the dividend stock side, because I think you can really have a lot of safety and yet have that dividend coming. But you do have to be able to stomach the ups and downs of the stock price, like we were talking about. You can have some of that, but you just really got to focus on the yield and stay with where that's at.
Yeah, absolutely. And I'm going to throw into the mix, you have to have discipline and patience, right? You got to have patience to ride out the market downturns and the discipline to stick with it. In the beginning, the dividends are small. You get like 20 cents a share, you get $1. That's not a lot. Now, here's the thing you and I were part of the FinCon community. We know a number of other individuals who have achieved FIRE. If you're young, you're in your 20s and 30s, and you still have a day job, the day job can cover your living expenses. You don't need the dividends. So what do you do with those dividends? Reinvest them into other dividend stocks.
Yep.
And that's how you're going to accelerate your dividend income growth.
Yeah. Well, or pay down debt too if you have to. Do whatever you need to do. Get yourself, look at it and get yourself in financial order. Like, get your house there, look at your expenses, look at your income. I think it's great to get started and get going with it, but kind of have everything in perspective for where you're at. But I think the dividends are great.
Yep, absolutely. Now, thank you for your story. I was just looking at this again. Incredible. You and your wife, it says here in the bio, never had a salary of over $65,000. Is that true?
That's true.
Okay, that's unbelievable. And then today, I don't know if you want to share with the audience, feel free to say no, your approximate dividend income, annual income.
Yeah, so it's going to be over 10,000 for sure this year. So the last quarter we were between 3 and 4 in the fourth quarter. It depends if you're saying what was paid or what was realized. You know how they issue the dividends a lot at the end of the year. If you go off issuance, it's closer to 4,000. If you go off payment, I think it's closer to 3,000. So for that quarter, and I really just started getting a lot of it invested in June. Now, I've done dividend stocks in the past as well. So like Visa is one I've had for a long time. You're talking about safe ones. You look at like a Visa, and they don't pay very much as a percent, but they're a great company. They cash flow like crazy. So
it's rock solid.
Yeah, it's rock solid. Yeah. So I think this year we're trying to get to like 25 or 30,000 would be our approximate goal when we get everything invested. I think we'll be 25, 30 with the rates that I've been finding and the market being where it's at. I right now, what I'm averaging about a 7% dividend yield on what I have invested, which is about 2 to 3% higher than I thought I would at this point. Because, you go back a year and your yields were just so much lower because the prices were so much higher and everything.
Yep. Incredible. I feel like we could talk about this even so much longer. We're talking about my favorite topic, which is dividend stocks. So thank you again, Brock, for sharing your story with us. It's such an incredible story, and you've achieved so much already. And I think you guys are going to have continued success. Brock, where can people find out more about you? Do you have a blog? Do you have a YouTube channel? Where can people get in touch with you?
So we're FIRE Travel Family, and you can find us across all the mediums on that. We have a YouTube channel. We haven't been doing a lot of videos lately. I'll just put that out there for people so they realize we've one of the things with FIRE that we've been able to do is we prioritize the stuff that's important. So we've kind of been working with some of my mom's health issues lately. We just had the baby, like I mentioned, and then I actually been dedicating a lot of time to my investment research. So that's one of the other things that's been really interesting, because you read the reports. Earnings time is a busy time of the year because I'm reading each of those earnings statements as they're coming out, and see what I can glean from that. But we put out a lot of content. We put things like about if you're trying to fly with young children, how do you do that? We have 10 points for flying with young children. That was really well received. We did a point where we went camping. We did a 3-month U.S. trip where we did it out of a tent and out of our van. And that was interesting. We did have some nights where there were storms or it was super cold, where we didn't end up staying in hotels. but we did about 75% of the nights actually camping. And that was a really interesting blog post. We kind of try to write the stuff that we couldn't find that we're looking for. All of our stuff, we don't have any ads on our site. We're just kind of telling our story, honestly. I was kind of talking to you when I come on. It's kind of an interesting spot because we kind of started this because we had so many family and friends who are like, hey, we want to know what's going on with you. And then I had people that reached out and said, hey, how does this go? Or, how do we fly with kids? Or how do we do this different stuff? Because they knew we did a lot of it. So we started putting the articles up. We've not really tried to monetize anything that we're doing yet. We've just basically put it out there, the information. And we do some updates about us and like that, so family can kind of see what's going on. So yeah, it's all Fire Travel Family. Like I said, YouTube, Facebook, Instagram. But mostly we haven't put much out in the last few months.
Well, we're going to put the links down in our description below to the sites you mentioned. I want to encourage everybody to go check them out. Brock, his wife and kids have an amazing story, so certainly do that. I hope our interview today has inspired many of you to get out there, start small, start slowly, and start looking at dividend stocks and start building your own financial freedom over time. So thank you, Brock, for being on our podcast today. I really appreciate it.
Thank you so much for having me, and I love what you're doing with this. This is awesome.